Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for tuning in for another episode of Zen and the Art of Real Estate Investing. I always say this, but I have a great show for you. My guest is Zihao Wang. Now, he is the founder of Motiva Holdings, but his backstory is about a family office. This is where he learned real estate through his mom, through his dad, through the family business, and how they figured out how to give him the responsibility to take it to the next level. I can't wait for you to hear the show. Let's get to Zihao now. This is episode 190 of Zen and the Art of Real Estate Investing with my guest, Zihao Wang. Zihao is the founder and CEO at Motiva Holdings. Motiva Holdings is a California-based real estate private equity firm focused on developing value-add and opportunistic, I'm going to talk to you about that, multifamily real estate opportunities through equity syndications and JV partnerships. Zihao, welcome to the show.
Thank you so much for having me, Jonathan.
Yeah, I'm really excited to talk to you. I love talking syndications, but I really love talking real estate in the background. And I know you got started with your family. So tell me the first time that you remember being involved in real estate, because I know it was when you were young.
Yeah, I got started when I was around 13, 14 years old. My parents originally made their money in the fashion industry, started in the late 1900s, started manufacturing in China, and then moved to the US in the early 2000s to start their own brand in fashion. It's still an active business today, but I think, after they moved here and made some money, they diversified into investing into real estate. Yeah. And as that portfolio grew, they knew one day they wanted me to get into the finance and investing world. So I joined in 2016 as a property manager.
Oh, wow.
Just on our family's assets. And they made sure I knew how to do everything though, learn everything, the days in, days out of operations. Yeah. And then moved me did that for 2 years and then moved me on to the acquisitions and capital market side. And so now I'm more of a high level, finding deals, raising equity kind of person now.
That's pretty interesting, though, because I've had a lot of people who have parents who immigrated to the United States, and a lot of them in the beginning, their parents didn't want them to go into real estate. They were like, you need to be a lawyer, doctor, or a pharmacist, or something like that. You didn't face that. Your parents were really good with, hey, real estate. We did it, and especially because they did it in the fashion industry.
Yeah, I mean, they were very big, business people and with a lot of, financial goals. So, yeah. I mean, we don't have a family lineage of, lawyers or doctors or any engineers or any of that sort. So, it was kind of what's the path of least resistance to, financial freedom and to financial goals, right? And they found real estate to be a great option. And so from a young age, they kind of guided and pushed a little bit into that direction. And it turns out I really like doing it. So it was a good synergy between us.
Yeah, that's fantastic because it's much more entrepreneurial. Some people think a lifetime of security means just locking down that W-2. But you really were always probably thinking different because your parents thought differently, right?
Yeah, for sure. It was very different in school as well. They didn't take school as seriously as most others. They were more thinking about what we can do in the business world.
Yeah, that's really unique, though. Have you found, though, over the years that that's a kind of unique way of everybody wants their kids to be successful. But I think a lot of parents, I know for being the parents of two adults right now, that sometimes you feel like, well, it would be nice if they just took the regular paycheck. But there's so much more scale to doing things on your own, figure things out and finding that entrepreneurship bug.
Yeah, I mean, they were very big on doing what I like to do, being creative. I mean, they kind of knew that taking the traditional path wasn't gonna cut it wasn't gonna cut it for me. I mean, they didn't
Yeah.
take a traditional path either.
Right.
So they were super entrepreneurial. I think that was part of their DNA. And so that was the mentality going in for me as well.
Well, how old were you though when real estate really clicked in your head, where you saw like your parents either doing something with the properties and you're like, wow, this is not only interesting, this is a great way to make money?
Well, I think when I moved on to the acquisition side of things, that really clicked in for me. So, I mean, when I started as a property manager, like it was just doing the work, right? It was
Yeah.
just learning everything. But when I got my like first acquisition, like myself, and then also first disposition myself, that was when the spread really became clear to me on how much you can actually earn and what kind of returns you can get. And, we're very lucky in that we were able to get a lot of great buys and a lot of great exits. So that really kind of showed to me what real estate's potential was. And so I think 2 years after I joined the family, it was when I really began to see what real estate was.
Yeah, don't you think that getting involved in the property management side first, that was a wise move for both you and just on behalf of your parents? Because then you really understand the nuts and bolts of how properties work, so that when you go to acquisitions, you can see a lot more of the holes that are there. Did that help you a lot being in property management for 2 years?
Yeah, it helped me. It definitely helped me a lot on the operations. It taught me what to do, what can go wrong. And then on the acquisition side of things, I mean, it's the line items of the model, right?
Yeah.
And then also just like connections wise, build a lot of connections within, other property management companies as well. Just talking to people about what they're doing with their properties, how their delinquencies are, how their rent growth is. And so by building that kind of relationship, now that even though I'm out of property management, I still leverage those relationships today. And then so yeah, it definitely was critical, I would say, in my real estate journey.
Yeah, and also helps you as you go up the scale to acquisitions and hire to know like how you can manage, because you guys are vertically integrated at Motiva, right? You have your own property management running.
Right.
Yeah, still, that's what you went into, but it must give you really good oversight on, hey, there's an issue with property management. They can reach out to you and say, hey, what's the problem here? And you can look through the line items and kind of what's been going on and probably figure it out a lot quicker.
Right, right.
What type of buildings or properties were your parents buying when they started? And then what were you looking to buy when you started?
We're big believers in the multifamily. So that's kind of my focus today and kind of how we got started as well. Obviously, the location expanded. So we originally started just in kind of Pasadena area. That's where we live.
Yeah.
Now we're kind of more into Orange County and then Empire. I'm looking at San Diego. And then also we have some properties in Florida and North Carolina and looking into Texas.
Yeah.
So, I mean, we've always stuck with the multifamily asset class. We do have a little bit of like retail stuff in the family office, but it's like very, very small allocation. Just kind of test out the water, see what's good, what's bad about these other asset classes. And, after running some of those, we felt multifamily still has a lot going for it. And that's kind of our focus today as well.
Yeah. How were you able to stick with it in California? It's a different market. I think people think, oh, California is tough. When you're in the large scale multifamily, it's a little different type of market. I mean, the cap rates are very, very low compared to other areas, but your appreciation and potential for redevelopment or reuse is extremely high, as well as appreciation. How have you been able to stick with it in California when others were just like, again, focusing on all the other areas or headed to the Midwest?
I think the mentality of investing is a little bit different. So we're not big like cash flow people that we need like a monthly or quarterly check or whatever.
Yeah.
We're more like, okay, so if we buy an asset today, what's it going to be worth in 5 years if we do our renovations and, boost the NOI? And that gap is much bigger in California than it is in like, for example, Midwest or other areas of Sunbelt, right? And so, oftentimes we buy in probably 100 basis points lower from a cap rate perspective than other states. But then when we sell, we're also able to, sometimes even compress that cap rate more in a good market than other states as well.
Yeah, I think that the premier product when you go out with the finished product is even more exciting in an area like California, because you do have big money coming in. So a lot of that big money is looking for something that's already is complete. There's people buying those. They don't want to go do what you guys have done to do the value add to get the value up. They just want to buy the cash flowing product in the end, which does turn out to be a cash flowing product. Maybe not the same as the Midwest, but also still appreciating. So you guys win, they win also in the long term.
Yeah, if you look at like statistics, like I think California is one of the biggest presence with 1031 money. A lot of foreign money and also kind of retired money comes into California for the good weather. They want to be close to their assets, and assets value usually stay high even in downturns here. Yeah. So for a finished product, we treat it kind of like a bond, potentially like a 5.5 cap bond, and then they can hold it. Nothing will really go wrong with that in California.
Yeah, that makes sense. I mean, I think when people are looking for 1031 exchanges, they're looking for things that are complete. They have a bunch of money that they have to park. So parking it in an appreciating asset is great. And as you said, I think it really helped you guys to not have to focus on cash flow, because I worry for new investors, even new syndicators who are really, really highly focused on cash flow, because I think they miss the capital expenditures that are coming, because the initial balance sheet or numbers on the spreadsheet, of course, they're going to look good. But usually right now, at least in this environment, very high cash flow means there's something coming later that's going to make that cash flow a lot lower. Have you seen that when you're vetting assets as well?
Yeah, I mean, like for us, the cash flow isn't really what we buy into, or we're more appreciation players. But also, like, I think one thing that's unique to California is just the difference between like in-place rents and market rents, right? So like, we can find stuff between $800 to $1,000 in rental upside in California, whereas Texas is probably capped at less than 300 or maybe 300 or above, but it's definitely not going to be higher than like 500, right? So it's that difference that we can capture here that essentially makes the value add a safer and less market driven play, right? So for example, in Texas, it's currently probably between $50 to $200 loss to lease, and then you have a bunch of supply coming up that pushes the market rents lower, so that even becomes smaller gap that really limits how much you can spend on capex and how much you can actually improve the building. Whereas here, we have probably $800 to $1,000 lost the lease. We spend $20 to $30K a unit on renovations. We still have a lot of upside to collect, when applied a cap rate onto that, right? So, it's a different way of doing things. I think it's less market driven, more value add in California. But then again, like there's pros and cons in every market, right?
Yeah, I just read something today on Texas, and 9 of the 15 biggest rent decreases across the country were in Austin, but I think people were mistaking that. It doesn't mean Austin's a bad market. It means they have a lot of properties, because the building was so big there. So there's a lot of properties coming online, which again may decrease your rent in the short term. But still, it's not like people are like, oh, I'm not going to move to Austin. Like now's a great time to move to Austin because the rents are all low. So people can opt to rent instead of buy and get like a premier product. Are you seeing that as you now have diversified outside of California into other markets? As you said, you can't evaluate the same way that you do California. You have to learn the new market when you get there.
Right. We're like very focused on expanding in Texas right now. And I didn't really look into Austin that much, but I looked into the DFW, and it's kind of the same story. A lot of things going for it, a lot of economic drivers, very diverse economic drivers as well. And then population growth. But then at the same time, it's kind of like, again, the smaller loss to lease, and kind of the price per unit is already baked into for the population growth and everything that's going for it. So we're still very cautious, but we definitely see the growth there, and then also the supply issues there, how easy it is to build. Yeah. So I mean, again, like we're trying to get into that market. We're trying to find the right deals and cognizant of all the risks, but also the upside of what's going for it in that market.
Yeah, I mean, if we're just comparing Texas to California, because of the metrics that you just talked about, when you're looking in Texas, are you looking to buy more units, in a complex, because then there's better scale for that 300 per unit as opposed to 800 per unit in California?
Yeah, we're definitely looking to buy bigger deals. I think, California, there's a limited supply of how many deals are above 100 units. Texas,
Yeah.
that's probably flipped. There's a limited supply of how many are under 100 units.
Yeah, I agree.
So yeah, well, we're definitely looking for bigger deals, and also, when we get into that market, we're probably going to use third party property management, just because we don't have local presence there. I do believe we're going to one day get vertically integrated if we do get into that market, like deep into that market.
Yeah.
But at least for the first couple acquisitions, we really need that scale to make a third party, worth it, and also, financially feasible.
Yeah, I mean, I think that helps you adjust to the market as well. You can only learn so much, but if you bring on local property management for the first couple, you start to understand the metrics that they've seen across their other properties, which can definitely help you in the due diligence phase.
Yeah, I mean, for sure, it's good to bring other people, experienced people on. But at the same time, I'm going to be pretty hands on myself just to learn about the ins and outs of that market. It's kind of like reliving the property management life from when I first started. So.
Yeah, but again, that goes back to that 2 years of experience is really helpful, because when you're talking, as somebody in your position now to a new property management team in another city, you've already done that, which is going to just earn a little bit more respect from people who just like, well, I don't really know what goes in. You guys figure it out, which is always a loss of money down the line.
Yeah.
Yeah. So as you're expanding, what are you looking for in terms of markets? Like, how did you go on Texas? Obviously, it was population growth, I think, is huge, because I think that's where people are getting confused. They see the rents going down, but that's not how it's going to be forever. There's a reason why all that stuff was built. No one's wrong about Texas. Everyone's still going to be moving there.
I mean, I started looking at the markets by talking to people, right? So I was talking to private equity firms, I was talking to family offices and JV equity on like what markets they're looking into, right? And so they were more looking into the red states.
Yeah.
A lot of people avoid California and New York, especially the private equity groups.
Yeah.
So, I was looking into those states as well, right? So Florida, North Carolina, we already have stuff there, but not that deep. 3 assets out of state. And Texas a lot of people were bullish on Texas. People, especially DFW, they saw the economic drivers and the population growth, and that kind of got me to making a lot of trips to DFW as well, and talking with brokers over there and really learning about the market. We don't have anything yet, but I think it's kind of like a learning curve for me, right? So once I hit my comfort level in terms of knowledge, then I think it's the right time to go in.
Yeah, I really like DFW. I'm in a 256 unit syndication as an LP there. And I find that for me, as now at this age, I like to invest in syndications, but I think it's cool because I can invest in a market, where I don't really want to go buy a single family house and see how it goes. I can get into multifamily without having any responsibility for doing any of the management. How are you finding your investors for you guys at Motiva, and what's your kind of ideal avatar for someone who wants to invest with you?
We're a little bit we target the family offices and the private equity groups.
Yeah.
So we haven't really syndicated smaller checks before. It's a function of both kind of my experience and my age and all of that. Like I don't connect with, for example, the doctors and the engineers and the lawyers. I connect more with other family offices who share similar, for example, immigrant stories, or private equity groups who are more focused on the numbers. And so, we've been trying to syndicate checks from, 500,000 upwards of $5 million. So it's our avatar is probably the more ultra high net worths or like a sub institutional group.
Yeah, more B2B than B2C, more business to business. Can you just, for other people who don't know, there may be listeners who don't really know what you mean when you say family business. Can you explain what you mean? Because I think it's an important dynamic for what you grew up doing and who you're looking to as investors, because it's not the same as other syndicators.
Like a family office or a family business?
Yeah, sorry, family office.
Yeah. So usually like a family office is, we have a really high net worth individual who made money in like a separate business and had either a liquidity event or is just really successful that their free cash flow got them a lot of income, right? And so they have a very sophisticated way of investing, usually a team to help them invest, and is usually diversified into all of the asset classes. So, for example, my family's family office, we're not just in real estate, but we're also into like venture capital, private credit, hedge funds, etc. And so they have a longer term approach for investing as well. They like kind of appreciation as
Yeah.
well. So some people like cash flow, but it depends. It's like what they're looked for is really dependent on the personality of the founder of that family office as well as its family members, right? But they typically write larger checks because they have the ability to do so, and also look for bigger assets and like to partner with other people, probably with a little bit more control themselves.
Yeah, and that's for people, they have, like you said, big windfall. They sell a company, they have to part with the money. There's a good way to put it out. They don't want to just leave it in a savings account. And I think also what you said is really important. They're looking for diversification. So if you have that type of asset class and management style that fits, it's easy for them to write a big check as opposed to going to what a lot of syndicators do, 50,000 here, 100,000 here. That's a lot. It's a different strategy, but you've kind of grown up doing it this way. This way seems really nice because those relationships that you build are even easier to just recycle because they don't really need the money back. I mean, if you just sold a company for, $1 billion and you can put in 500,000, $1 million into a deal, you're just going to keep rolling that snowball. It's really like unlimited compound interest money for them.
Right. We have investors that we worked with for 8+ years that, got in originally, and then we've been 1031, rolling into different assets, rolling up most of the time. And so, yeah, it's definitely a relationship business that I think, once you've proven, the trust and the ability, they stick with you. And that's kind of how we've been able to grow.
Yeah. And diversification's cool because within real estate, you can be completely diversified, not just in asset classes. Like you guys are interested in multifamily, but by going into 4 or 5 different markets, those are diversified assets, even though they're multifamily, because they don't operate the same and the metrics for those areas are not the same. So is that fun for you? Because it seems like you really do like the market part, establishing it and then looking at the data, because it's almost like a different game each time to play.
Yeah, one of my favorite things to do is keep a deal tracker. So every deal, like every OM I see with a whisper price on it, I put it into my Excel sheet with. So it's like many, many hundreds of rows, and then I was able to get it onto a map with the address, so I can really see, like, for example, a new deal comes in, where, like, what are the comps that I've seen before. And so it's definitely interesting to see kind of the markets as well as kind of the fluctuations in value and rents over time as well. So yeah, that like market stuff is definitely something I'm really interested in.
Yeah. And I mean, a lot of people have been, I guess, doom and gloom on multifamily. But again, I think it's something that they just don't understand. There's just a lot of bad debt out there. So some syndications failed. But you guys are obviously still bullish on multifamily. Everybody that I've had on the show is still like, yeah, multifamily is going to be great. It's just a little bit of a different trajectory now. Are you guys feeling the same way? Like it's not a problem. Like, oh, all of a sudden multifamily in America with also an affordable housing crisis is going to go down.
Well, I mean, we're big players on capital preservation, right, as a family office. So we don't over-lever ourselves.
Yeah.
So we cap ourselves pretty much at 65, maybe 70% leverage.
Yeah.
And that's because we need to know that in the worst case scenario, we're able to recoup our money back, with a 0% return. And so we're not trying to hit home runs with, 85% leverage. And if the market goes up, we hit a, 50% return. And if the market goes down, we lose the asset. Right. We're more about, let's see if we can hit 20 to 30% returns and over every year for like 3 to 5 years and then exit to something else. So we're much safer in terms of that regard.
Yeah, and that's a perfect match to your investor avatar, right? I mean, that's what the people who invest with you are looking for, that safer. They don't need the cash flow similar to what we talked about, but they want that nice solid return and expectation of appreciation on almost like can't miss, barring something crazy that happens in the world, which, is happening here and there. But still, if you wait it out, it should still be fine.
Right.
Hey, it's Jonathan. I hope you're enjoying this episode with Zihao Wang. On this brief interlude, I just want to talk about Bigger Pockets. They're not paying me to say this, but I've been using Bigger Pockets as a user for more than 10 years. And I remember after more than 20 years in real estate at the time, finding the site and being like, what is this? Why didn't I know about this before? So if you haven't been on Bigger Pockets, Pretty easy. Go to biggerpockets.com, make a profile, put your profile photo in there, give a background so you become a real person on the internet, and start interacting in the forums. The better questions you ask, the better answers you'll get, and I hope to see you there. Let's get back to the show. With those markets that you're interested working in now, because you said Florida, North Carolina, Texas, California, all four of those have environmental issues that have come up. Are you seeing any issues with the rising cost of insurance? Because those are some of the hotbeds for insurance pop-ups. But I would guess because of the way that you're doing due diligence, it's just going to be a longer term play and you're pretty safe on those.
Yeah, acquisitions has been hard because of the insurance, and it's non-controllable, right? So it's like you really can't do anything. But, kind of in California, I actually think it's good. Well, it's not good, but it's easier to deal with because your rent pops are able to go much higher, right? So it's not like it's cutting into that much, especially if you can get $800 in rental upside and then an insurance increase of like $200 is not that bad. In the other markets of like Texas, Florida, North Carolina, where rental upside is much smaller, it's been tougher. The good thing is like kind of our assets out of state right now are ground up stuff. So with new much construction, it's much better. But still, it did get like hindered, right? So in terms of new acquisitions, really really tough trying to get assets to pencil. In terms of existing assets, we're very lucky that they're newer products out of state, and then in California we have that rental upside.
Yeah, that's really important. I mean, you get obviously better insurance with the new builds. You're going to have builder's warranties, so you're kind of set up overall for a safer product than buying something in 1970s in an area where it needs a lot of renovations also. That's really important because I think it's something for people to look at. Even as LPs, you may think like, hey, well, I don't want to worry about it. They've got it taken care of. It's still good to know, that there's rising insurance in those markets, and your GPs or people controlling the deal are cognizant of that and looking out for, what the long-term tail looks like for that.
For sure. Yeah.
Yeah. In terms of what you like as assets, are you only interested in multifamily? You said you guys are playing around a little in retail. I'm just curious, are there any like other areas, asset classes where you personally are like, that might be interested, might want to talk to everybody about this?
Yeah, so we played in retail. We feel retail is really hard to value add though. It's not really for value add anyways. It's more for like a cash flow play.
Yeah.
So we've got stuff like Walgreens. We've got our own, shopping center as well. And it's on triple net. Yeah, it's on triple net. So there's nothing much we can do. And typically those leases are long-term leases with a bunch of options laid into it. So, if we don't buy a market rent asset, or if market rent moves too fast up, then we're still stuck, right? So I just feel the operational flexibility is so small in retail, and like, for example, medical office buildings as well.
Yeah.
Anything triple net is just the operation and efficiency is just so low that I'd rather, as a young person, I'd rather play another asset class.
Yeah.
We've looked at kind of storage as well, kind of building storage or buying value add storage. And it's just, people are scared of supply in multifamily. Supply is a lot scarier in storage than it is in multifamily. Because if a public storage is right next to you, you're pretty much dead.
And those big companies are buying up all the little ones. So you end up, a game that used to be like pretty mom and pop is now not mom and pop at all.
Yeah. But one thing that I'm looking into, and I hear a lot when I go to conferences, I think is small bay industrial.
Yeah.
So that's something, I'm looking into and seeing if that works. I've never done it before. So talking to a lot of people, ears wide open and trying to learn as much as possible.
Yeah, I really like the idea of industrial flex. We've had a few industrial episodes, and I was a partner in industrial for over 20 or 30 years. I just think it provides that kind of like slidability of assets now, because what I saw with mine was originally it was just typical industrial, but then over time where we were in Long Island, it was like no one wanted to be on Main Street anymore. So they started moving cooler type of businesses to industrial, and we're looking around like, this kind of feels like, what a general strip mall would feel like, but higher end, but it's still in this industrial area where you have a ton of parking And then I saw it in California over the years, taking my kids out there and seeing my sister, a lot of the pop-up stuff for kids is all in industrial areas. You're like,
Right.
hey, where are we going to this trampoline park? I don't even know where this is. And you're going down all these weird, corridors. And then you're like, oh, wait, here it is. Because it's a giant building that doesn't cost a lot to build. It's going to make a lot of income.
Exactly. Yeah. And it still has the operational flexibility to do things. So it's something I'm looking into, and I'll let you know if I decide to go with it.
Yeah. I was curious though. So in California, what's like a kind of just a general average in terms of like unit count that you're buying into as opposed to these other states? Because we were saying before, these other states are probably looking to go bigger because of the scale. In California, what does your number look like versus maybe out of state, Texas, Florida, comparatively?
So in California, we've done small buildings as small as 7 units. We've done big buildings around 90 units. We've always stuck with kind of below 100.
Mm-hmm.
But I mean, we've looked at like 300 unit buildings in California as well. But then that number just gets really massive.
Yeah.
But in terms of like Texas, for example, we're really only looking for stuff above 100 units to 500 units. And to be honest, the pool of buyers and sellers is different there. It's a lot more like syndicators, whereas here it's like 1031 money. So if you buy too small of an asset over there, it's hard to sell too.
Oh, interesting. Yeah, that's a great point.
Yeah, I mean, like if you try to convince a 1031 like mom and pop owner to buy a 10 unit building in Texas, they'd rather buy a 10 unit building in California where they live. So it's different pool of buyers and sellers, and we're cognizant of that as well. And then also just kind of mentioned before, the operational efficiency with third-party management. We need that scale.
Yeah. So for you guys at Motiva, I mean, are any of these assets that you take, are they going to be a complete hold, or are they all meant to turn around and sell at one point, like, 5 years, 8 years? What's the cycle on those?
Now we're more looking into like 5-year holds with an exit.
Yeah.
When we first started, so for example, we still own the first building that my parents bought.
Oh, wow.
16-unit building in Pasadena.
That's kind of cool. That's cool.
Yeah, we have no equity in there though. So we refinanced over the years multiple times.
Yeah.
So I think when we first started, it wasn't as active as it is today. So it was more like, let's just buy this thing and then hold it for a long time. And we bought it at a good time. It was back in 2008.
Yeah.
So, before it was kind of like, let's just hold and see what we can do with it. And then kind of we're now turning into more active, because when the exit happens is when we can recoup a lot of the money and a lot of the profits. So it's more active today.
Yeah, but you've used that first asset as a, hey, let's just keep refining that, taking more money out. So it doesn't have the equity, but it's been serviceable equity for probably a bunch of other deals that you've done.
Yeah. We've taken the equity out and parked it into other assets for sure.
Yeah. I mean, that's just smart business. When you look at it, this is just the way that your parents figured out how to do real estate when they came here, right? I mean, the one thing that I find really interesting about this is that a lot of people who immigrated to the United States got into real estate. And they just built a business. Like anybody could build a business like this right now. Everybody's busy looking at TikTok and Instagram for tips, when the real money investors just did it the way that everybody always used to, and nobody knows who they are. Have you found that, just coming from parents who probably don't have like a really active TikTok account?
Yeah, I mean they're very more hands-on people, the internet people. So and also the personality of my parents is we want to do the things and know why things went wrong or why things went well, right? So they always took a more of a, I would say, GP approach and LP approach. And even today, they're still very hands-on people. They like to see the assets, see the numbers, and understand what they're going into and stuff. So yeah, they're very much, trial and error and trial and fail and figure out and see what makes things good.
Yeah, you talked a lot before about building relationships, when you were in property management and how that helped you, but it must really have helped your company's overall strategy for your parents to kind of go with that family office mentality, because a lot of people don't know where to start, and it's hard to just go out and start asking for money. But when you come from family offices, a lot of them know each other, so you can kind of cross-pollinate each other. Maybe you're going to invest in something that they have, and they're going to have a built-in trust knowing that you've done that. Has that helped kind of make it at least an easier transition for you going into that company rather than having to do what we were talking about for traditional syndication, which is let me pick up a bunch of new people who are going to write smaller checks?
Yeah, it's helped a lot. One, it's built a track record for me, kind of without me having to do much in terms of capital raising. And then two, as kind of I mentioned before, it's easier communication and easier trust. So, most of our family offices that we work with are like immigrant stories, and they understand kind of building a business ground up in a foreign country with language barriers is very, very difficult. And my parents can communicate with them on that side of things. And also family offices tend to be more entrepreneurial as well. Having a younger person run your asset is something that most smaller check writers are uncomfortable with.
Right.
But, for the family offices who also, have kids kind of like my age, right? And they understand kind of, that there is a trust building process, but after that trust building process that they scrutinize, they can kind of let go and trust that, I can actually be very active and do things really, really well. So in terms of communication and also building that track record, it's been very, very helpful. I don't think I would have gotten to where I am today at this age without the support of my parents.
Yeah. And even if you had obviously the smarts that you do have to do it, like you said, people are going to look at you. You look young. I know you're not very old, but they're going to just think like, oh, well, you just don't have the track record or experience, not realizing that maybe you don't have the years that other people have, but by growing up in that family and understanding and following along in the same line, again, that plays a big role in that family office. But hopefully things like this help to explain to people, like, it's not like, I always say, like, I would be worried for like brand new syndicators, but if I also knew that they were in a family that had done syndications before, I'd be like, oh, okay, and they're still lining up the same thing. That would make a big difference to me personally.
Yeah, and also I would say just to add another thing is also like how much skin in a game we have. As a family, we part of it is investing, right? And so, when we find a really good asset that we want to be part of, we put in a significant amount of the equity, right? Sometimes, like 50, 60% of the equity is from our family. And so when we have that kind of capital commitment, it's when other family offices see that, they don't see a young kid running a property anymore. They see it more as, a young kid being a representation of a family who has been very successful in both, their operating business as well as investing, working with them. So it's a different perspective.
Yeah. I meant to mention that before because when you talked about what type of equity was in there, it's so important. Skin in the game as somebody who's looking as an LP, what to invest in, or like you said, business to business, what they're looking to invest in. The skin in the game is really important because you don't really, me personally, I don't want to invest with someone who has no money in it because then I don't feel like they're very tied to the investment. If we're making their whole investment, it's kind of almost a little uncomfortable to me.
Right.
Yeah. And that's also an old school thing. My dad was the same way. The funny thing about my dad was, and my dad came from nothing, built up, a real estate portfolio as well, but he didn't like partnerships. He had a lot of them, but he was usually like the money of the partnerships. And then the other partners were just his friends. So after he passed away, we're like, why are these people partners in these deals? And we couldn't like figure it out. Like, well, I don't see any deposits. They didn't bring anything to the table. So he was a nice guy, but I think we had us in partnerships. Were you in partnerships with your parents? So on deals when you were younger, like early, very young, because I was, and that helped me kind of frame real estate better.
Yeah, so I was the GP, they were the LPs.
Oh,
Yeah. So they set up a company originally. They were still the shareholders of it because of just how young I was. But I was basically the CEO of that company, and they'd lend me money to put as like a 10% GP money into a deal, and then they put 90% of the LP money, and then that, like, once that deal finishes, I return kind of the money I borrowed to them plus some interest. Usually very, very low interest. They were very kind to me.
Yeah,
but
there's something to be said for family there.
yeah, exactly. But I gotta pocket the profits and roll into the next deal and stuff. So they made sure everything was as formal as it can be, and they wanted to kind of teach that to me as well. So
yeah, I think outwardly people who maybe don't grow up in that type of environment, they look at it and like, oh, well, you had it easy or I had it easy because our parents were involved. But I think when you start doing deals with your parents, it's very uncomfortable. Like they did give you a favorable rate, but I'm sure they were watching everything that you did to make sure that you were learning. My dad was very lax, but on money, he was really about like looking at it, how much are you going to make? And then when he saw, oh, like you did really well on your first flip, the same thing, like, let's do it again. I want to help you do it again. Have you found that that's the case? Because I think some people can kind of like misperceive that it's easy just because there's money involved. But, working with your parents when you have a good relationship is great, but there's still a high level of scrutiny there.
Yeah, I mean, my parents still have very high expectations in terms of deal performance. So,
yeah,
and deal performance, no matter whether you work with family or not, is very difficult. And so, from that perspective, yeah, it's not easy working with parents, because I treat them just as if they were outside LPs, right? And so from that perspective, deal performance is still the most important thing. And so I still try my best to deliver that performance and try to make sure that we're all happy in the end in terms of how much profits we're able to make.
Yeah, that's a really important point for people who have parents who are going to help them get even involved in their first investment, whether it be a house hack, multifamily. I thought the same way. I wanted to make sure I was just doing the right thing no matter what, not taking it for granted. You obviously seem to as well. And that's a great way to approach it, though, for a new investor who has parents who are like, hey, we're going to kick in. We believe that you can do this, but like, we want to see that you're doing it the right way. So you have to do it, as you said, the same way, have the same deliverables so they feel like a client and they can trust you as outside of, hey, that's our son or, uncle, aunt, whatever it is.
Exactly. Yeah. It's building trust within the family as well.
Yeah, right. They trust you to go like get the right stuff for dinner. But once there's a big check on the table, you definitely have to produce a little bit more just to prove that you can do it.
For sure. Yeah.
Yeah. So for you guys, what's your main thing now for Motiva? Are you looking to expand into new markets or expand inside those markets that you just have a little bit in, Sunbelt, Texas type of areas?
Yeah, so we want to do our first acquisition in Texas. We're still kind of expanding slowly in California because we already have a pretty big portfolio here, and we don't just want to, stop. We know where the good pockets are, and we have local boots on the ground here. So I think that's something we can leverage. But I'm probably going to take a little bit. We have a team of 10 already here, so I'm probably going to have other people handle more of the operations in California. They're very experienced to do so as well.
Yeah.
And I'm probably going to be exploring different markets to see where the next opportunity is. Yeah, it's kind of two goals for us.
Yeah. Are there any other states out there that you haven't even really vetted that at least are like a little bit piquing your interest based on stuff that you looked at besides the one that we've talked about?
I've looked at, so I've seen like kind of the rental fluctuations of recent years, and it seems like Midwest is getting their fair share of attention now, with Sunbelt kind of slowing with all the rental supply.
Yeah.
I just haven't really researched too much into the Midwest. I think the general consensus, if you go to like a conference, is that like Midwest to the Sunbelt people can be very boring and not very like appreciative.
Yeah.
So, I still got to look into kind of the Midwest and see where that's heading.
Yeah.
But from my primary focus has been in the Sunbelt and the Smile states.
Well, all the oldest investors always say that the most boring investments are the best ones.
Yeah.
They carry the least amount of risk. They just kind of slug it out and deliver the returns nice and easy.
Mm-hmm.
Yeah. Awesome. Zihao, where is the best place for people to get a hold of you? Is it through motivaholdings.com?
Yeah, I'm also active on LinkedIn. So, feel free to reach out on there as well.
Yeah, I love LinkedIn, by the way. It's like when I started on LinkedIn, you were probably like, like a baby. But LinkedIn used to have this like real business feel. You couldn't even get messages. It's becoming a little bit social media, but I think it's going to trend back. I think it's, it's where business people are. So for somebody like you, LinkedIn is a much better platform for what you guys do in terms of who your avatar is than Instagram. I still like Instagram as well, but it just makes sense that LinkedIn would be a platform that you would be spending more time on in that B2B nature.
Yeah, I love LinkedIn. I get to connect with a lot of people, and also like the content of LinkedIn, I think is really, really beneficial. I try to spend between an hour or two a day on LinkedIn, scrolling past, what people are posting. And usually, their AI algorithm, once you look at a bunch of businessy posts, then you get, only fed businessy posts. So, I learned a lot from other people on LinkedIn as well. So,
yeah, I just think if you're looking to go into bigger deals, LinkedIn is definitely a place to spend more time than TikTok. Nothing wrong with TikTok. I deleted it, but it's not a good use of my time now. But LinkedIn is a great use of my time. They can find you on Instagram yourself, too. I know you're on there as well, right?
Yeah.
Awesome. Well, it's been a pleasure having you on. I'm glad we got this in. It's good to talk to someone else who's been involved in the family business. Mine was a little different kind. Yours was much bigger. But it was great having you on the show, and I appreciate you spending the time with me.
Thank you so much. It was fun. Thank you for having me.
Absolutely. That was Zihao Wang of Motiva Holdings. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who the next episode is with. And next episode, my guest is Randall McLaird. You may have heard his name because I was on his podcast, Agents Building Cash Flow, a while ago, and now I've returned the favor. Randall is the founder of Ridgeline Investment Group, and they acquire and manage income-producing properties. It sounds like a story you've heard before, but it never is when we get to people's backstory and their experience. This is a great show. Next episode with Randall McLaird.